My name is Gayatri Arbugam. My matrix number is 0608023F1068. The case I'm presenting is case 2. The first one is case summary. A firm of accountants was appointed 5 years ago as the external accountants for a fast-growing startup company. The firm is responsible for preparing the company's year-end accounts and tax returns. Over time, the company expanded from a small group of employees to around 200 staff members, becoming large enough to require a statutory audit. Through close interactions with the company's directors and employees, it was discovered that staff purchases of goods produced by the company were being approved by production managers and processed outside the official accounting system. The money collected from these unregulated transactions was used to fund the company's annual Christmas party. This situation raises serious ethical concerns, including a lack of transparency in financial reporting, possible breaches of accounting standards, and the misuse of company funds for unofficial purposes. Next is ethical problems. Lack of transparency in financial records. The company's transactions are not fully recorded in the accounting system, meaning the financial statements do not show the true financial position of the business. This lack of honesty and transparency is unethical because it misleads those who rely on the financial statements, such as investors, auditors, and regulators. Possible breach of accounting standards. Recording transactions outside the accounting system goes against professional accounting standards and internal control principles. It creates opportunities for fraud, manipulation of financial data, or misuse of company resources. Such behavior undermines the credibility of the company's accounting system. Misuse of company funds. The proceeds from unrecorded staff sales were used to fund a Christmas party, which is not a legitimate business expense. This is considered misuse of company funds, as company money shall be used only for authorized business purposes. Integrity and objectivity issues. When accountants or company managers are aware of unethical practices but choose not to take corrective action, it reflects a lack of integrity and objectivity. Accountants must act honestly and without bias. Failing to do so damages professional credibility and violates the ethical codes of conduct. Affected parties. The first affected party is the accounting firm. The reputation and independence of the accounting firm are at stake. If they fail to report or address the issue properly, they could be accused of negligence or complicity in unethical behavior. This could result in disciplinary actions, damage to their credibility, or even legal consequences. Next is the company. The company's financial statements are inaccurate because of the unrecorded sales. These can create serious legal and financial problems, especially during audits or tax reviews. The company could also lose the trust of investors, customers, and other stakeholders. Next, the company's directors and management. The directors and management are responsible for ensuring ethical and transparent financial practices. By allowing or ignoring off-record transactions, they are complicit in unethical behavior. They could face both professional and personal consequences if found responsible. Next, the production managers. These managers are directly involved in authorizing and managing the unrecorded transactions. Their involvement makes them accountable for unethical practices and violations of internal control procedures. Next is the employees. Employees who participated in unrecorded purchases might not have realized the seriousness of their actions, but their participation still contributes to the ethical violations. Next is the users of financial statements. Users such as investors, creditors, tax authorities, and other stakeholders rely on accurate and truthful financial statements. Misleading or incomplete records can result in poor decision making and loss of confidence in the company. Next is fundamental principles. The first is integrity. Integrity involves being honest and truthful in all professional and business relationships. In this case, failing to record all transactions accurately is a breach of integrity because it hides the true financial situation of the company. Next is objectivity. Objectivity means not allowing bias, conflicts of interest, or undue influence to affect professional judgment. The close relationship between the accounting firm and the company's management may affect the accountant's ability to make fair and independent decisions, especially if they hesitate to report the issue. Third is professional competence and due care. Accountants must maintain professional knowledge and skill to ensure that their work meets high standards. Not following proper accounting procedures or failing to maintain accurate records shows a lack of due care and professional competence. Next is confidentiality. While accountants must maintain client confidentiality, they also have a duty to act when they discover unethical or illegal practices. In this case, they must find a balance between confidentiality and the duty to report misconduct. Lastly, professional behavior. Accountants must comply with laws and regulations and avoid actions that discredit the profession. Failing to act on this issue or covering it up will damage the credibility of both the accountant and the profession. Next is key consideration. Accuracy of financial reporting. All transactions, including staff purchases, must be recorded properly in the accounting system. Accurate financial reporting ensures that financial statements present a true and fair view of the company's financial position. Second is compliance with accounting standards and laws. The unrecorded transactions and misuse of funds could violate accounting standards, tax laws, and company policies. The issue must be collected and disclosed immediately to maintain compliance. Next is auditor independence and professional judgment. The accounting firm needs to assess whether its relationship with the client could affect its independence and objectivity. The firm must remain unbiased and perform its duties based on professional judgment, especially since the company now requires a statutory audit. Next is ethical responsibility to act. Accountants have a responsibility to maintain integrity and transparency. They must decide how to address and report the unethical behavior, even if it means facing conflicts between confidentiality and professional obligations. Next is evaluation of possible solutions. First is report and correct the unrecorded transactions. The accounting firm should advise the company's management to record all staff sales properly in the accounting system. Any money collected shall be included in the company's financial statements to ensure accuracy and transparency. Next is address the misuse of funds. The money from staff sales should not be used for non-business purposes such as a Christmas party. Management should either reimburse the funds or obtain proper authorization to use them as official company expenses. Next is strengthen internal controls. The company should review and improve its internal control system to prevent unauthorized transactions. Clear policies and procedures should be established for staff purchases and for how company funds are managed. Lastly, communicate with those charged with governance. The accounting firm should formally raise the issue with senior management or the board of directors. Open communication ensures accountability and transparency in addressing unethical practices. Lastly, the conclusion. The conclusion emphasizes that ethical behavior is essential in maintaining trust, transparency, and accountability in financial reporting. When financial transactions are carried out outside the official accounting system, it weakens the accuracy and reliability of financial statements. Such actions can lead to misleading reports and damage the reputation of both the company and the accountants involved. The case reminds us that the accounting firm has a professional and moral duty to follow the fundamental principle of ethics, which are integrity, objectivity, and professional behavior. Acting according to this principle ensures that the financial statements present a true and fair view of the company's financial position. It also highlights that when accountants and management take responsibility for their actions, maintain independence, and correct unethical practices, they can rebuild confidence among stakeholders. By doing this, both the accounting firm and the company can regain trust, protect their reputations, and uphold ethical and professional standards expected in the accounting field. In short, the conclusion reinforces the message that ethical conduct is not only about following rules, it's about ensuring honesty, fairness, and professionalism in every aspect of financial work.